Welcome, everyone, and thank you for joining us today as we discuss the period end financial close with focus on notes payable accounts. Conducting an audit of key accounts on a period basis is critical to ensuring that all expenses are accurately captured and expensed to the correct accounts. Now, while the P&L is the most popular report because it creates the most action from an operational perspective, but also understanding and tracking the balance sheet is key to knowing your restaurant's financial health. Each period, you should review the financial statements, identify areas of opportunity and the key behaviors that cause them, then establish where you can make an impact and who should be responsible for enacting those changes. Note payable accounts reflect the restaurant's current debt balance for any loans and/or promissory notes. Understanding your debt not only allows you to make smart business decisions, it allows you full visibility into what you truly need to contribute in order to break even. Inaccurate balance sheets are also an indicator that expenses are missing, which means your P&L is potentially inaccurate as well. So what causes a notes payable to not reflect the correct balance? When recording loans and payables, splitting out the interest is key to ensure that the true balance of the loan is reflected and the expense, being the interest, is recorded on the P&L. When the payments to the loan are not recorded and when questioned on the bank reconciliation, they are miscoded. When payments to the loan are recorded through the bank, that is not being reconciled. For those of you on RASI, cash management will play a large part in ensuring this does not happen in the future. And lastly, when expenses paid by the loan are not coded as paid by the loan account when recording accounts payable, this could result in a negative liability. If the balance is off, there are a few steps to correct it. If the loan account is overstated or reflects less available credit than it should, review the trial balance of the loan account to determine the incorrect activity. Review the trial balance of the interest account on the P&L to verify that all interest made on the loan has been recorded accurately. And once you identify the activity that is not accurate, communicate this with your accountant so that they can make the correct journal adjustments. Now, if the loan account is understated or reflects too much available credit, review the trial balance in the loan account to determine any inaccurate or more common missing activity. Once that's been identified, communicate to your accountant so they can make the necessary adjustments. When submitting accounts payable, here are a few best practices. Look for any invoices that are paying down the loan to ensure that principal and interest are broken out separately. The principal payment will reduce the liability loan amount on the balance sheet and the interest with expense to the profit and loss statement. Audit invoices that are paid by the notes payable to ensure they are marked as paid by the correct payment method, which in this case would be the payable. This ensures that any invoices paid by the notes payable increase the total liability to show that it was used to make purchases. If you have any questions on how to set up or pay notes payable, reach out to your accountant to ensure that all considerations are taken and it is set up properly based on the parameters of the loan. Now that you know how to true up these accounts, first review the notes payable accounts and communicate any needed adjustments. Then complete the reconciliation with focus on these accounts to ensure that all activity to the notes is properly recorded and expensed. Lastly, communicate with your teams to ensure that these accounts stay clean on a period-over-period basis moving forward. Thank you so much for joining us, and have a wonderful day.